Okay, everybody, here we go. Here's the question I get the most. People say to me, Bruce, I watch your classes all the time. I talk to you when you're doing your live show every Monday to Friday at 8:30 in the morning Eastern time. I listen and I read all the comments from all the other folks who are members of your channel. One question I have, I never get the answer to, I really don't know what to make of this, is how much profit should I take if I write stock options? Should I just have a rule, like make it just 30% or 50%, or as soon as I'm up 75% or 100%, what do I do? If I write a call, should I let it just expire? Should I just buy it back when it's 25 cents? Like, help me out here. All right. You got to understand something, kids. When you're an option writer, you're always an option writer. And there are times where you can make some pretty good coin and you can feel pretty good about yourself. Like this guy right here. I mean, this guy's doing great, living the dream, baby. You want to be like this person right here? You're going to have to figure out a couple things about option writing. First of all, this is the typical layout of a firm where there are a ton of professional option writers who are out there writing calls on millions of dollars of stock all the time, every day. And they're playing against stocks that trade down here on the New York Stock Exchange and the NASDAQ and around the world. And this is the world in which option traders, react to, and whatever the stocks do down there, their options are going to do here. If you're going to be an option writer and you want to quit your day job, or you want to enhance your IRA, your RRSP in Canada, you want to build a retirement pool that's going to be worth something when you reach a certain age of retirement, your 50s, your 60s, 70s, you're going to have to generate income. And income is generatable by writing options against stock you either have or stock you're going to get, or you're going to do the poor man covered call strategy, and you're going to go to my website, you're going to take my classes, and you're going to figure out how it's done. If you go to my website, this is the home page. This is the class page right here. There's the tab on the top. Attention students, and you're going to take this class number 11, you're going to take number 12, you're going to take number 13, you're going to take number 14, and so on. You're going to learn how it's done. But once you've written some calls, whether you've written calls on calls you own, stock you own, the question is, when do you take a profit? Now, let's just give you a generic example, all right? I mean, a lot of my viewers who hang out with me, they write options on GameStop, they write options on Tesla, they write options on Apple, they write options on Cisco, Pfizer, HPQ, Hewlett Packard Enterprises. Whatever company and a stock you're comfortable with, these are a selection right there. Some of these are more speculative, some are very volatile, some are very conservative. But let's just do this. Let's suppose you're writing an option on GameStop, and the shares are trading at I don't know, 17 bucks a share, just kind of where they are right now. Today's date, Friday, March 17th, 2023, they're around 17 bucks. If you own the shares of GameStop and you write a call against the shares, right now, I would be telling you to be looking at calls that are maybe 3 months out, 4 months out, 5 months out into the future. I am telling my viewers, I would be looking at late summer into fall now. Why? Because you want to get premiums. You want to get a lot of cash in your hand to make this move. You're offering the world a chance to buy stock off of you at a set price. You want a lot of money in your hands, and you want to do an out-of-the-money call. What does that mean? The stock's trading 18 bucks. You're going to offer stock at $20, for an example. You might offer your shares of GameStop for 4 or 5 months at 20 bucks a share, and you may be paid about $3 to $3.50. Okay, let's think optimistically. You get $3.50 for every call option you sell, you write, which means you're offering your stock at 20 bucks a share for 4 or 5 months, and the individual has to give you right now $3.50 times 100 shares per contract, 350 bucks cash in your hand right now. You write one call, you get 350 bucks. You write 10 calls, you get $3,500. These are American dollars, real dollars if you're from Canada or anywhere else. So you bring in, let's say, $3,500. Let's just say there's some money coming in. It's $3,500. You have 1,000 shares of GameStop. You wrote 10 calls. or you own 10 deep in the money calls that you bought way in the money, and you're writing 10 calls on those calls. Again, take my classes to understand all of this stuff. You've brought in $3,500. Bruce, when do I buy these back? What is there a hard and fast rule? I like to use one of the laws, or one of the rules I like to follow is the law of diminishing returns. And here's the thing. There are times where the shares are $17, $18 a share, and you're writing $20 calls. And a week or two later in time, as time is going by, these calls are slowly losing value because they're losing time of existence. They're going to expire 3-4 months from now. Every week that goes by is more time lost on the contract's lifetime. They're going to slowly depreciate. But the other thing that can make a call option go down in value is if the shares themselves slump. And what have we noticed lately? And we notice this all the time. Markets fluctuate up and down. Stocks go up and down, sometimes crazily in one day. Sometimes over a week, over a month, they can make a nice move. So if we assume for a moment that GameStop shares are going to have a bad week or two, and they go from $17.50 down to $15.50, just for like a couple of days, and then maybe they'll drift back to 16.5. But let's say they do drift down to 15.50. You're a shareholder of the company anyway. You're not going to sell the stock. You're going to hold it for the long haul. Fair enough. What you are looking at, though, are those calls you sold for $3.50. You sold call options, $20 each, for $3.50. What are they trading at now? If the shares go down in a couple of weeks to $15.50 a share, could it be that those shares, when they were $17, $18 and you received $3.50 for, could they be trading around $1.50 to $1.75? Very possibly, yes, because at $15.50 a share, your $20 calls are $4.50 out of the money. No one's going to exercise your option and want stock from you at $20 if they're trading at $15.50. Nobody. So the shares have zero, the contracts have zero value. The only value they have is the time that they have left to live, which means in the amount of time that's left to go, if the shares do rise back up towards $20, the contracts will have more value. And at $18 or $19, those calls will be back to $3.50 a piece, maybe $21, $22 a share on the open market. These contracts might trade with the time premium left on them. They might trade at $4.50 or $5. People who bought at $3.50 would now be making money. But in the meantime, they've drifted down to $15.50 and they're sitting at $1.50. People ask me, is this the good time to buy them back? My thinking is law of diminishing returns. If this call option had 4 months when you wrote it and now has 3 months left, in 1 month, you've made $2 on the depreciation of this contract. That's $200 in your pocket, or $2,000 on all 10. You can only make $1,500 more. You can't make more than another $1,500, because when you write a call for $3.50, you are selling it. You are creating a call contract that now trades on the open auction market. That $3.50 call is the most you can make, $350 if it becomes worth zero money at the end of its life. But right now it's worth $1.50, and it's got 3 months left to live. It had maybe 4 months left. It was a 5-month contract, 4 months to go. It's a 4-month contract. It's got 3 months to go. It's got a long time yet to go. It's $1.50. It's way out of the money. And you're sitting there going, what should I do? I've been crossing my arms, watching this go down. I'm up $2,000. My attitude on it is I'd buy them back. Why? Because you can only make another $1.50 over the next 4 months or less, or ballpark, 3 to 4 months. You've already made $2 in 30 days. You can only make $1.50 in the next 90 days or 120 days. And so you're better off buying these up now. And what you could do, in theory, is you turn right around, buy these up, and then write brand new calls that have 4 or 5 months to go again. This new calls 2 months further down the line, maybe October's now. And you're going to write perhaps $18 calls. You had written 20s, now you're writing 18s, and you're bringing in $3.50 a call again. You're looking to bring in another $350 a contract, $3,500. You've got $2,000 sitting in your account because you bought these back for $1,500 that you sold for $3,500. Now you just added another $3,500 cash into your account. And now you're sitting on $5,500 in cash, and you're crossing your arms going, well, If the shares stay under $18 between now and 5 months from now, these contracts aren't worthless. And if the shares even recover back to 16.5, these contracts are still not worth any money because they aren't even at $18. These calls have to go to like $21 or $22 for me to be worried about it. Because at $21, $22, down the road a month or two, these contracts will be trading at around $3.50, $4. You sold them for $3.50 originally. You don't mind if the stock goes back to $18. You own the shares. You're a long-term shareholder. You'd rather they're $18 than $15.50. Why not? That's great. They're back to $18. You're happy. The calls are $3.50. You don't care because they're worthless. They have an $18 strike price. The stock has to trade over $18 to have any value. And as each day and each week goes by, these contracts shrink, shrink, shrink. Now, let's assume 3 months down the road, the shares are trading at $17.50 to $18. And your call options are $2.50 to $3 because they've depreciated a little bit, but not a lot. But they appreciate a little bit because your shares have appreciated. Now, what do you do? Are you up a lot of money? No. Are you up some money? Yeah, you're up a little bit of money. What are your choices? Well, you could buy back these calls for $2.50, $2.75, make a buck, make 75 cents, $750, and you could turn around now and write new contracts that are now 20s again because the stock has come back into the 17.50, 18 range. You could write $20 calls that are now good for December or January. Again, further out for what? $3.50 or so. And you could take a new position at that level. That's called a rollover, where you're rolling over one call into another call. You've made some money on this first one, bought them back maybe at $2.75, made 75 cents on this little trade, and now you're writing brand new $3.50 calls for way out here. Higher strike, $20 versus $18. So there's no hard and fast rule. You notice quickly there's no hard and fast rule. On the first example, it was a law of diminishing returns. There's only $1.50 left and there's 4 months to go. I don't want to wait 4 months to get $1.50. I just made it $2 in a month. On the second batch of contracts, the shares came up. Great, they did. And your calls have still shrunk anyway because time has gone by. And now you're taking advantage of that by buying these out, ending that contract as far as your obligation is concerned. And now you're writing 10 new contracts good for December or January for $3.50 again at a $20 strike price. Right what you did the first time all around. You've been a shareholder the whole time. You're still going to be a shareholder. And you're sitting there going, well, if the shares go higher, I'll buy back these calls and write even higher priced calls. If these shares go lower, I'll buy back these calls and I'll write lower priced calls. I win either way. The shares don't do anything. They sit around $17.50, $18.50 for a month and a half. They don't do anything at all. I win. Why? Because these contracts I sold for $3.50 are losing time, and they will eventually be worth zero at the end of their lifetime. They're going to lose 20 to 25% of their value every month anyway on shrinkage. Unlike George Costanza, who loses a hot date, you love shrinkage because if the shares don't go anywhere, the contracts shrink out and you keep the change. That's a quick little idea of just how it works with regards to depreciation, rollovers, taking advantage of a dip, all this kind of stuff. But you've got to understand how options work, how they're created, how they trade, the psychology of the markets themselves. You've got to understand the best price to get through a stink offer, the best way to get them back on a stink bid. You have to understand the time frame left. You have to be able to calculate out in your mind the best time to make your move, buy these back, and score a nice return. All of this is available on my website, stockmarketswithbruce.ca. Get your butt over there and check out my website. It's from Canada. That's why it has a CA ending. Stockmarketswithbruce.ca is Canada. Head on over there and check out the classes. You'll find that there are 14 of them, numbers 1, 2, 3, 4, 5, 6, 7, 8. Each class will run you $150. They last an hour and a half to about 2 hours each, all in plain English. And they're done with a live audience, and you'll be able to hear the questions that people ask me as I am teaching the classes one by one. You'll quickly figure out, oh, it's the same gang that hangs out with this guy when he does his live shows Monday to Friday. It's the same people. The comments up and down the channel. They're the ones who took the classes and continue to add on to the classes. Join the party. Learn how options work. Run through these 14 classes. Once you bought them, you own them forever. You can watch them as many times as you want and learn how this business works. And this, you'll understand why every week trillions of dollars of options expire every week. There are trillions of dollars of contracts in existence out there at any time, all the time, on all kinds of stocks. And you'll understand how this all fits in and how it'll work for you. If you want to quit your day job, learn how to write options on your portfolio. The better an option writer you become, the sooner you can say, bye-bye, boss. I'm not working for you anymore. Thanks for joining me on this little video. I hope you like it. We'll see you Monday to Friday, 8:30 Eastern time on Stock Markets with Bruce, where we try to answer questions and explain the market in plain English and figure out how to make money writing options. Thanks for joining me today. Have a good one, everybody. Bye for now.